For nearly a century, the US dollar has been the bedrock of global finance. But are we starting to see the first serious cracks in that foundation? Around the world, there's a growing debate about the dollar's dominance. We're seeing a combination of political uncertainty, new economic pressures, and a coalition of nations actively looking for alternatives. This isn't just a headline for Wall Street. It has real implications for the money in your wallet, the value of your savings, and the price of everything you buy. In this video, we'll break down what's really happening, why it's happening now, and what it could mean for you. Section 1. The shifting economic winds. To understand the pressure on the dollar, we have to look at the big picture. After a long bull run that saw the dollar index peak in 2022, the economic landscape is changing. The US economy is projected to grow around 2.1% to 2.4% this year, a healthy number, but a slowdown from the post-pandemic rebound. In response to slowing growth and easing inflation, the Federal Reserve has shifted its policy. After a series of aggressive hikes, the Fed began cutting interest rates in late 2025, bringing the benchmark rate down into the 3.5% to 3.75% range. The market expects perhaps one more cut this year. So why does this matter for the dollar? Simply put, when a country's interest rates are lower, it becomes less attractive for global investors to park their cash there. While the Fed's moves have been cautious, this shift away from high interest rates removes a key pillar that was holding the dollar up, adding sustained downward pressure on its value. Section 2. The question of political stability. Economic policy is only half the story. The other half is trust. For decades, global investors saw the United States as the ultimate safe harbor because of its political stability and predictable policy making. But that confidence is being tested. Increasingly, investors are forced to price in a new kind of risk, political uncertainty. Discussions around the Federal Reserve's independence, threats of sweeping new tariffs, and general policy unpredictability create an environment of doubt. For the investors and central banks in London, Tokyo, and Beijing, who hold trillions of US dollars, this raises a critical question. Is the US still the world's most reliable place to store wealth? This isn't just a short-term worry. It's a structural concern about the long-term credibility of UN institutions. When the world's so-called risk-free asset, the US Treasury bond, starts to feel like it carries political risk, investors naturally begin to look for safety somewhere else. Section 3. What this means for your wallet. So, what does a gradually weakening dollar actually mean for you? It's not just numbers on the screen. It's real money out of your pocket. First, your cost of living can go up. A weaker dollar means it costs more to buy imported goods. That phone in your hand, many of the clothes you wear, and even components in American-made cars are often sourced from overseas. As the dollar's value dips, the price you pay for those items tends to creep up. Second, international travel gets more expensive. That vacation you've been planning will cost you more because your dollars buy less foreign currency. Third, the value of your savings can be affected. If your wealth is primarily in dollars, whether in a savings account, a 401k, or cash, a declining dollar means your global purchasing power is shrinking. You're not necessarily getting poorer, but your money doesn't go as far on the world stage. Before we get into the massive global power shift that's gaining momentum because of this, take a second to hit that subscribe button. This is a story that is unfolding over years, not days, and understanding these forces is the first step to protecting your financial future. Your support helps us continue to break down these critical economic trends. Section 4. The rise of the alternatives. The dollar's challenges have created an opportunity for others. For years, we've heard whispers of de-dollarization, and now we're seeing it happen, not at lightning speed, but steadily and deliberately. The BRICS nations, Brazil, Russia, India, China, and South Africa, now joined by countries like Iran, the UAE, and Egypt, are leading the charge. These countries have launched initiatives to trade among themselves using their own local currencies, working to bypass the US dollar. For example, a significant portion of Russia's trade with its BRICS partners is now reportedly conducted in local currencies, a dramatic shift driven by both strategy and sanctions. This isn't just a political statement, it's the slow construction of a new financial reality. Systems like BRICS are being developed to create an alternative to the dollar-based SWIFT payment system. While these systems still face major hurdles, the direction is clear. A growing part of the world is actively building a financial system that is less dependent on America. Section 5. Gold's enduring appeal. As faith in government-issued currencies faces headwinds, many are turning back to one of mankind's oldest stores of value, gold. We've seen gold prices hit new records, recently trading in the $2,300 to $2,700 per ounce range after a strong run-up. This isn't just speculation by individuals. It's a strategic move by central banks. For the last few years, central banks around the world have been buying gold at a historic pace, adding over 1,000 metric tons to their reserves annually. This is a clear vote of no confidence in the existing financial order. These institutions are looking at geopolitical, tensions and economic uncertainty and choosing to move a portion of their wealth into a physical asset that cannot be printed or devalued by a single country's policies. When traditional safe havens feel less safe, gold often becomes the default choice. Section 6. The reality check. Can the dollar be dethroned? Now, it's important to be realistic. Is the dollar going to disappear tomorrow? No. Despite these growing challenges, its dominance is deeply entrenched. The infrastructure of global finance is still built on dollar rails. Even with a slight decline, the dollar still accounts for around 58% of global foreign exchange reserves, according to the latest IMF data. The next closest currency, the euro, makes up only about 20%. The Chinese renminbi, despite all the attention, still represents only a tiny fraction of global reserves, hovering around 2%. The alternatives face huge challenges, the biggest being liquidity. It's still far easier for Brazil to buy oil from Saudi Arabia using US dollars than to try and exchange their currencies directly. Overcoming that massive network effect could take decades. So, a complete collapse isn't the most likely outcome. What we are witnessing is not the death of the dollar, but perhaps the end of its absolute, unchallenged reign. De-dollarization is a slow, grinding process, but it's real. It's chipping away at the foundation of American financial power, one bilateral trade deal, and one gold bar at a time. The story of the US dollar is becoming more complicated. Economic headwinds and a shifting interest rate policy are creating pressure. Questions about political stability are eroding the foundation of unquestioned trust. And a coalition of rising powers is seizing the moment to build an alternative. The era of absolute dollar dominance is facing its most significant test in generations. The world is slowly but surely repricing risk, and the US dollar is no longer the only game in town. The question is no longer if the financial world will become more multipolar, but how fast and what the new global order will look like when the dust settles.